Welcome back to the deep dive. Today, we're going to do something a little different.
I think so, yeah.
Usually when we talk about money, about finance, we tend to fixate on the result. We talk about the dream retirement, the cabin by the lake.
The destination.
The destination, exactly. The ability to quit a job you hate. That's what we talk about.
Well, of course.
Mm.
That's the fun part. That's what motivates people to even bother in the first place.
It is. But today, we're going to completely ignore the destination for an hour. We're going to open up the engine room, we're going to pop the hood, and look at the actual mechanics of the vehicle that most people are driving toward that retirement. I'm talking, of course, about the mutual fund.
It really is a bit of a paradox, isn't it, when you think about it?
How so?
Well, if you look at the average retirement account, a 401k in the States, an RRSP up here, any standard savings plan, it's almost entirely powered by mutual funds.
They're everywhere.
They're absolutely ubiquitous. Trillions and trillions of dollars are sitting inside these structures. And yet, for the vast majority of people, they are a total black box.
That is the perfect term for it, a black box. You shove money in one side.
Usually automatically from your paycheck, so you don't even see it.
Right, you don't even feel it. You wait 20 or 30 years and you pray that a bigger pile of money comes out the other side.
You hope for the best.
But if you ask the average person how that pile got bigger, or, who is actually holding their money, or why their balance just dropped by 5% last month, you just get silence.
Which is actually, it's quite terrifying when you really stop to think about it.
Yeah.
For most people, next to their home, their mutual fund portfolio is the largest single asset they will ever own.
Ever, by far.
And yet, they probably understand the mechanics of their toaster better than they understand the mechanics of their life savings.
So that's our mission for this deep dive. We've got a massive stack of source material here today. We've got textbooks on portfolio theory, regulatory documents on how these funds are structured, guides on financial analysis. We're going to try to strip away the jargon.
We're not just going to say buy low, sell high.
No. We are going to look at the mathematical and the structural reality of how these things actually work.
And we are going to cover a lot of ground. We're going to talk about something called the efficient frontier, which it sounds like a sci-fi movie, but it's actually a crucial concept for your wallet.
We're going to break down the specific way a single dollar gets into the fund and how it gets out.
We'll even look at the legal protections, the things that are supposed to stop a fund manager from just running off to the Cayman Islands with all your cash.
And we're going to look at risk. We're going to look at it in a way that, and I don't say this lightly, it might actually scare you a little bit.
Oh, but in a good way.
In a good way. The forewarned is forearmed kind of way. So let's start at the very foundation. Before we can get into the, the nitty-gritty of balance sheets and bond durations, we have to understand the philosophy, the why. Why do mutual funds even exist in the way they do? Why don't we all just buy one stock and, hope for the best?
It all comes back to a concept that completely, and I mean completely, revolutionized finance back in the 1950s. It's called modern portfolio theory, or MPT.
MPT.
Right. This is the big idea. And it's really hard to overstate how much MPT changed the game. Before this theory came along, the investment strategy for most people, even for a lot of professionals, was largely just stock picking.
Finding the needle in the haystack.
Exactly. You'd look for a company you liked, a railroad, a steel mill, whatever it was, and you'd buy its stock. If you were really sophisticated, maybe you'd buy two.
Right.
The focus was entirely on the individual investment's merit. Is this specific company a good company?
And modern portfolio theory just flipped that on its head.
Yeah, completely. MPT came along and said, stop looking at the single investment in isolation. Start looking at the portfolio as a whole. As an organism, it shifted the entire focus from picking the best player to building the best team.
I love that sports analogy. It makes so much sense. It's the difference between trying to draft the single best quarterback versus trying to build the best football team.
Yes.
You don't want 11 quarterbacks on the field no matter how good they are. You need different positions that react differently to what's happening in the game.
That's a perfect analogy. The core insight of MPT is that investments shouldn't be evaluated just on their own potential return, but on how they relate to each other, how they interact.
So not just how good the quarterback is, but how well he works with the receivers.
The fit. The goal is to construct a portfolio that reduces your overall risk while hopefully enhancing your potential return. And it provides a mathematical framework for actually doing that.
Okay, so this brings us to that sci-fi term you mentioned, the efficient frontier.
It is a great name. And it's actually a really powerful idea to visualize. It's a graph.
Okay.
Imagine a chart. Along the bottom axis, the horizontal one, you have risk. So the further to the right you go, the riskier things get.
Got it. Risk on the bottom.
And then up the side, the vertical axis, you've got return. So higher is better.
Risk versus reward. The classic trade-off.
The classic trade-off. Now, for every single level of risk you're willing to take, let's say you're a medium risk person, there is a theoretical maximum return you can possibly get.
There's a ceiling.
A ceiling.
Yeah.
Exactly. You can't get infinite return for medium risk. And if you plot that maximum return point, that ceiling, for every single level of risk, from low to high, you get this beautiful curved line that arches up and to the right.
And that line is the frontier.
That curve is the efficient frontier.
So if my portfolio is plotted as a dot and that dot is on the line, I'm doing great. I'm optimized.
You're doing great. An optimal portfolio sits right on that frontier. It means you are getting the absolute most bang for your buck, the most return for the amount of risk you're taking.
But I'm guessing most people aren't on the line.
Not even close. Most amateur portfolios, and even some professional ones, are plotted as a dot that sits below that line. They're inefficient.
What does that mean, inefficient?
It means one of two things. Either they are taking on, say, a medium level of risk, but they're only getting a low-level return.
When they could be getting more.
When they could be getting more for that same risk. Or the other way around, they're getting a medium return, but they're taking on a crazy high amount of risk to get it. They're working too hard, risk-wise, for what they're earning.
So the whole job of a mutual fund manager, in theory, is to use math and strategy to push that portfolio, that dot, up onto the efficient frontier.
That's the goal. That's the game.
And the primary tool they use to do that, to move that dot up the chart, is diversification. But our source material makes a really nuanced point here. It's not just about having a lot of different things.
No, this is the key. This is what most people miss. Many people think diversification just means buying many things. But if you own stock in American Airlines, Delta, United, and Southwest, you are not diversified.
Because if the price of jet fuel goes up, they all get crushed together.
Correct. They are highly correlated. They move in lockstep. MPT doesn't care about the number of things you own. It cares about combining assets that are dissimilar.
Like our sports team, a quarterback and a linebacker.
Exactly. The classic pairing is equity stocks and fixed income bonds. Historically, they don't move perfectly together. When stocks are zigging because the economy is booming and everyone's optimistic,
Bonds might be zagging, or at least not zigging as much.
right, they might be staying flat or moving in the opposite direction. And the math proves that by combining these assets that have low correlation, you reduce the overall volatility, the risk of the whole portfolio.
And you do that without necessarily having to give up all the potential return.
That's it. You smooth out the ride. And that's often called the only free lunch in finance. You get a benefit, risk reduction, without an equivalent cost.
Okay, so that's the theory. Build an efficient portfolio with uncorrelated assets, but a manager can't just go to the store and buy efficiency. They have to pick actual companies to put inside the fund.
That's right.
And this is where we move from the high-level theory to the real-world practice. This is the manager's toolkit, financial analysis.
I like to think of this as the health checkup for a business. A good portfolio manager acts like a doctor. They can't just guess if a company's healthy. They need to look at the charts, the blood work, the vitals.
And the vitals in this case are the financial statement.
The 4 pillars of financial statements.
Yeah.
And yeah, I know for a lot of people, their eyes glaze over when they hear that term.
It sounds like homework.
It does. But
Yeah.
they're really just the scorecards for a business. They tell a story. The first one is the balance sheet.
The snapshot. I remember that from the outline.
That is the best way to think of it. It freezes time on a specific day, usually December 31st, and it says, what do we own? What do we owe? And what is left over for the owners?
So that's assets, liabilities, and shareholders' equity.
That's it. And there's a reason it's called a balance sheet. It's because it's based on the fundamental equation of accounting, which is that assets must equal liabilities plus shareholders' equity. It has to balance.
Why? Why does it have to balance?
Because it tells you the story of how the company is funded. It's basically saying that everything the company owns, every factory, every truck, every patent they hold,
All the assets.
right, all of that stuff was paid for in one of two ways. Either by borrowing money, which is a liability, or by the investors putting their own money in, which is equity. It shows you how the whole machine is funded.
Okay, so that's the snapshot. Then we have pillar number 2, the income statement.
If the balance sheet is a snapshot photo, the income statement is the movie.
I like that.
It tracks activity over a period of time. a quarter, or a whole year. It starts at the very top with revenue, all the money coming in the door. Then it starts subtracting all the expenses.
Salaries, rent, the cost of the materials.
Marketing, everything. And the very, very bottom, you get the famous bottom line, the net profit.
Yeah.
This tells you if the company is actually making money from its day-to-day operations.
But profit, on paper can be a bit tricky, right? Which is why our sources say we need the third pillar, the cash flow statement,
Yes, this is the reality check.
the reality check.
You can sometimes, let's say, manage your profit with complex accounting rules. You can recognize revenue before you actually get the check from the customer, for instance.
Okay.
But you can't fake cash. The cash flow statement tracks where the actual physical cash is moving. Is it coming in or going out?
And the source material breaks it down into 3 buckets, 3 activities.
This first is operating activities. Is the cash coming from selling your products and services? That's healthy. That's what you want to see.
And the second.
Investing activities.
Mhm.
Is the cash coming from, say, selling off a factory? That might be a bad sign. It's like selling the furniture to pay the rent.
Not sustainable.
Not at all. And the third is financing activities. Is the cash coming from borrowing a massive new loan or issuing new stock? So a manager looks at this statement to see if the company is surviving by selling widgets or by just taking on more and more debt.
So if the income statement says, hey, we made a huge profit, but the cash flow statement says we are bleeding cash from our core operations.
That is a massive red flag. Huge. It tells you the profit isn't real, or at least it's not sustainable.
Okay, and the fourth and final pillar is the statement of retained earnings.
This one is pretty straightforward. It just tracks a key decision. Did the company take that profit it made and pay it out to shareholders as a dividend? Or did they retain it and reinvest it back into the business to grow? It shows you the company's philosophy on growth versus rewarding shareholders right now.
So the manager has all these documents, but here's the problem I see. How do you compare a giant company like an Apple or a Microsoft to a smaller, up-and-coming tech firm?
You can't.
The raw dollar amounts are they're on different planets. Apple's numbers will be 1,000 times bigger.
The scale is too different, and that is exactly why we use ratios. Ratios make comparisons fair. They strip away the size difference and look at efficiency and health in relative terms.
Our sources highlight 4 main types. Let's run through them. First up is profitability.
This measures, pretty simply, the ability to generate profit from the company's resources. A really key one here is the gross profit margin.
Okay, what's that?
It's your revenue minus the cost of goods sold, so what it costs you to make the thing you sold. And then you divide that by the revenue. It tells you for every single dollar of sales, how much is actually left over after you pay for the product itself.
So if Company A gets to keep 40 cents of every dollar it makes in sales, and Company B only keeps 10 cents.
Company A is much more efficient. It probably has a competitive advantage or maybe better pricing power. It's a healthier business.
Okay, then there's liquidity. This is about survival, right? Short-term survival.
Exactly. The classic ratio here is the current ratio. You take all your current assets cash, things you can sell quickly, and you divide them by your current liabilities bills you have to pay soon.
So it's asking if all your bills came due tomorrow, could you pay them without having a fire sale?
That's precisely it. The higher that ratio, the safer the company is in the short term.
Then we have the debt-to-equity ratio.
This measures leverage. How much is the company relying on borrowed money versus the money provided by its shareholders? High debt is risky, obviously, because you have to pay that interest no matter what, good times or bad.
But it can also be a good thing.
It can. If used wisely, debt can supercharge productivity and growth. It's a delicate balance that a manager has to assess. Is the company using debt wisely, or are they just in over their heads?
And that brings us to the final one, which is probably the one that investors hear about the most. Valuation ratios, specifically the PE ratio.
Ah, yes, the price to earnings ratio. This is the price tag of the stock relative to its actual profit. The source gives a great simple explanation for this.
Which is?
If a company has a PE of 20, it means investors are willing to pay $20 for every $1 of that company's annual earnings.
That sounds really expensive. Why would I pay $20 for a dollar?
One word, expectation.
Ah.
That's the key. A high PE ratio means that investors expect high growth in the future. They're paying a premium now for earnings they believe will show up later. It allows a manager to compare the expensiveness of different companies relative to their growth potential. A PE of 50 might be cheap for a fast-growing tech company, but insanely expensive for a slow-growing utility.
Okay, so the manager has done all this work. They've analyzed the companies, picked the winners, built this beautiful portfolio on the efficient frontier. Now let's pivot back to the listener. How do they actually make money from all this?
Right.
The source material is very clear that a mutual fund makes money for its investors in three specific ways.
It's not just the price goes up, which is what most people think. The first way is income.
Okay.
The fund holds hundreds of stocks and bonds. The bonds pay interest, and many of the stocks pay dividends. All of that cash flows into the fund. That's income.
Makes sense. What's the second way?
Realized capital gains. This happens when the portfolio manager decides to sell a security, a stock, for example, for more than they originally bought it for.
So they lock in a profit.
They lock it in. That profit is realized, and it becomes part of the fund's return that can be distributed to investors.
And the third way is the one we usually watch on the ticker tape every day.
That's capital appreciation. This is the increase in the value of all the securities that the fund is still holding. It's unrealized because they haven't actually sold anything yet, but the total value of the portfolio has gone up.
And that's what drives the unit price, the NAVPU, up. I want to zoom in on how this works specifically with bonds for a second, because the source material provides a really detailed scenario here that I found super helpful. It clarifies how price and income interact.
Yes, let's walk through that, because bond math can be a little counterintuitive. So let's assume the fund holds a simple $1,000 bond that pays 5% interest.
Okay, so every year that bond spits out $50 in cash.
Right. $50, that's your income. That part is predictable and easy. But the price of the bond itself, what you could sell it for on the open market today, can change.
So scenario one from the source, the price of the bond stays perfectly flat at $1,000.
Simple. Your total return for the year is just the $50 in interest you received, a 5% return.
Okay, easy enough. Scenario two, the market price of that bond drops to $980. First, why would it drop?
The most common reason is that interest rates in the wider economy went up. So if new bonds are now paying 6%, your older 5% bond is less attractive. Its price has to drop to compete.
Got it. But I still get my $50 interest check, right?
You still get your $50 that is contractual obligation. But the value of your asset, the bond itself, dropped by $20. So your total return is the $50 of income minus the $20 capital loss.
So I only made $30 total.
Right. The income helped cushion the blow of the price drop, but your return was definitely tempered.
And the final scenario, scenario three, the price rises to $1,010.
Now you're winning on both fronts. You get your $50 in interest, plus you have a $10 unrealized capital gain. Your total return is $60. This interplay between the steady income and the fluctuating price is critical to understanding total return, especially in a bond fund.
And speaking of total return, the source material points out there's a distinct way this is calculated for regular mutual funds versus, say, a money market fund.
Very different, yes. For a standard stock or bond fund, the official total return calculation always assumes that all those distributions, the dividends, the interest, the capital gains, are immediately reinvested back into the fund.
So it assumes you're compounding your growth.
Exactly, which is what most long-term investors do anyway.
But what about money market funds? They're different.
They are. They often quote something called a current yield, which is just a simple annualized percentage based on the fund's income over the last 7 days. It's a snapshot.
But that's not the full story.
No. You have to look for the effective yield. The effective yield accounts for the effect of compounding interest, earning interest on itself throughout the year. It will always be slightly higher than the current yield, and it's a much more accurate picture of what you're actually earning over time.
Okay, this is a good place to pivot. We've talked a lot about making money. Now we have to talk about the scary part, losing it. Or, more accurately, the risk we take to get those returns.
Absolutely. A return figure is completely meaningless without understanding the risk that was taken to get it. I mean, if you tell me you made 10%, my first question is, okay, but what was the downside? If you risk losing 100% to get that 10%, that was probably a terrible investment.
The source material categorizes risk into three big buckets. And the names are tricky: systemic, systematic, and unsystematic. Let's try to unpack these.
Let's start with the biggest, baddest one on the block, systemic risk.
Okay.
This is the domino effect. The classic textbook example is the collapse of Lehman Brothers in 2008.
Where one bank fails and suddenly the whole world financial system is on the brink of collapse.
Exactly. It's the risk that the failure of one large, interconnected institution triggers a chain reaction that threatens the entire system. You can't diversify against this because the system itself, the plumbing of the market, is broken. It's rare, but it's catastrophic.
Okay, that's the big one. Then we have systematic risk, which is also called market risk.
Think of this one as the weather.
The way
Yeah. It affects everyone. If interest rates rise sharply, or inflation spikes, or a war breaks out, the entire market tends to suffer. It doesn't matter how good your specific stock pick is. If the overall market is tanking 20%, your stock is probably going down too.
And this is the key point. You cannot diversify this away.
You cannot. It is the price of admission for investing in the market. It's the risk you get paid to take.
Which leaves us with the third one, unsystematic risk.
This is the specific risk. This is the risk that one specific company has a terrible CEO who makes bad decisions, or one of their factories burns down, or they get hit with a massive lawsuit.
So this is the risk that diversification does fix.
This is exactly what diversification is designed to fix. If you own 50 different companies and one of them has a factory fire, it's just a small blip on your radar. The other 49 cushion the blow.
So we know the types of risk. How do we measure them? The sources give us some math here. Standard deviation, beta, and duration. Let's start with standard deviation and the bell curve.
Standard deviation is the classic measure of volatility. It tells you how much a fund's returns tend to swing around its long-term average.
So it measures how wild the ride is.
Precisely. The source material compares two hypothetical funds to explain this: the Lowell Fund and the Darwin Fund.
And they both have the same average return, right? 10% a year.
Exactly the same average. But the Lowell Fund has a standard deviation of 5. That means in a typical year, its return could be anywhere from 5%. That's 10 minus 5 to 15%, 10 plus 5.
That's a pretty wide range.
It swings wide. Now compare that to the Darwin Fund. It has a standard deviation of only 2. So its returns typically range from 8% to 12%. It's a much, much steadier ride.
So even though they have the same average return, Lowell is considered riskier.
Much riskier. Its range of possible outcomes is way wider. And that's what the bell curve visualizes. Is the bell tall and narrow like Darwin, or is it short and wide like Lowell?
Okay, then there's beta. This one is about comparing a fund to the market itself, right?
Yes. By definition, the market index, like the S&P 500, is assigned a beta of 1.0. So if a fund also has a beta of 1.0, it's expected to move in perfect lockstep with the market.
And if it's higher than 1?
If the beta is greater than 1, say 1.2, it's wilder, more volatile than the market. If the market goes up 10%, this fund might go up 12%.
But the reverse is also true.
The reverse is also true. If the market drops 10%, this fund is expected to drop 12%. It amplifies the market's moves, both up and down. And of course, a beta of less than 1 means it's steadier and less volatile than the overall market.
Now, for the one that I think confuses people the most, duration. This is strictly for bonds.
It is. And the technical definition is a bit dense. It's the weighted average time it takes to get your money back from the bond. But that's not very helpful.
So what's the simple takeaway?
The key takeaway for every listener is this: duration equals sensitivity to interest rates. That's all you need to remember.
The source material has a key concept here that I circled. Longer duration equals higher risk.
That is the iron law of bond investing. Think of it like a teeter-totter. If the plank is very, very long, that's long duration, then a tiny little movement at the pivot point, that's interest rates, causes a huge dramatic swing at the ends of the plank. And that's the bond's price.
So if you're waiting 20 or 30 years to get your principal back, a small change in interest rates today can have a massive impact on your bond's value.
A huge impact.
Yeah.
Because interest rates could skyrocket over that time, making your old low-rate bond look terrible by comparison.
And there's a nuance here in the sources about the coupon factor, the interest rate on the bond.
Yes, and this is another one that feels backward at first. The source compares bond C versus bond D. They both mature at the same time, let's say in 10 years. But bond C has a low 4% coupon, and bond D has a higher 5% coupon.
Okay.
Which one is riskier? It's bond C. The one with the lower coupon actually has a longer duration and is more volatile.
Wait, why? That feels wrong.
It's because bond D, with the bigger 5% coupon, is paying you your money back faster with those bigger interest checks along the way.
Oh, I see.
You're getting more of your total return sooner. With bond C, more of the bond's total value is trapped until that final principal payment way off in the future.
Yeah.
Therefore, the lower the coupon, the longer the duration, the higher the risk.
That is a really, really helpful distinction. Okay, we've covered the theory and the math. Now let's look under the hood at the actual structure. Because a mutual fund isn't just a concept, it's a legal entity with people running it.
It absolutely is. And as you said in the intro, it really does take a village to run a fund.
So first, what is it legally?
Well, most funds, at least in Canada and many other places, are structured as trusts. In that case, you, the investor, are a unit holder. Some, more common in the U.S., are set up as corporations where you are a shareholder.
Does that difference matter to the average person?
It mostly affects how things like taxes flow through the fund, which can get complicated. But for our purposes, let's focus on the people, the mutual fund complex running the show.
Okay, so first up is the investment fund manager.
That's the boss, the organizer, the brand name you see on the building. They're the ones who set up the fund, handle the marketing, and hire all the other key players.
And they hire the portfolio manager.
The brain. This is the person or the team that is actually making the investment decisions. They're the ones analyzing those financial statements and deciding what to buy and sell.
Now, here's the one that I think is the most critical for investor safety, the custodian.
The vault. This is, without a doubt, one of the most important and overlooked roles. The custodian is the entity that holds the actual cash and the securities.
And the key is that they're separate from the manager.
Crucially important. By law, the custodian must be separate from the manager. This is what prevents a Bernie Madoff situation, where the manager is just faking statements and running off with the money. The manager directs the trades, but the custodian, which is usually a major bank or trust company, is the one that actually holds the assets.
So the portfolio manager can say, buy this, but they can never actually touch the money.
They never have custody. It's a fundamental check and balance in the system.
Okay, then we have two other roles, the transfer agent and the independent review committee.
The transfer agent is the record keeper. They're the ones who track exactly who owns what units of the fund. They process your purchases and your sales.
And the IRC.
The Independent Review Committee, or IRC, is the watchdog. They are there specifically to look out for and rule on potential conflicts of interest between the fund manager, who wants to make a profit, and you, the investors.
It really is a whole system designed to keep things honest. Now let's talk about the mechanics of us, the investors, getting our money in and out, buying and selling. The price we pay is called the NAVPU.
The net asset value per unit. And the calculation is actually pretty simple. You take the total assets of the fund at the end of the day, the value of all its stocks and bonds. You subtract any liabilities the fund has.
Like fees it owes.
Exactly. And then you divide that big number by the total number of units that investors own. That gives you the price per unit for that day.
But the timing of when you get that price is weird, right? If I buy a stock on a trading app right now, I see the price change instantly. Mutual funds don't work like that.
No, they use a system called forward pricing. If you put in an order to buy a mutual fund at, say, 10:00 a.m., you don't actually know the price you're going to pay yet.
Really?
You get the price that is calculated at the close of business that day, which is usually 4:00 p.m. Eastern Time. And if you place your order at 5:00 p.m., after the market closes, you've missed the cutoff. You get tomorrow's closing price.
So you can't time the market during the day? You can't day trade mutual funds?
Absolutely not. They are designed from the ground up for long-term holding.
And speaking of long-term holding, the source material brings up a classic strategy called dollar cost averaging, or DCA. And it uses a character named Bernie to explain it.
Chuckles. Right, a much more innocent Bernie this time.
Let's hope so. So Bernie decides he's going to invest $1,000 a month for 6 months. He's not going to try to time the market. He's just going to be consistent.
Right. And the market, as it always does, is volatile. The price of his fund bounces around. It starts at $52, goes up to $54, then drops all the way down to $48, then back up to $53. It's all over the place.
So what happens?
Here's the magic of it. When the price was high, at $54, his $1,000 investment bought him fewer units. But when the price crashed down to $48, that same $1,000 investment bought him more units.
He naturally bought more shares when they were on sale without even trying.
He did it automatically. And the result, as the source shows, is that the average price of the fund over that 6-month period was around $52.80. But because of this effect, Bernie's average cost per unit was only $51.88.
He beat the average price just by being consistent.
He did. And more importantly, it removes the psychological stress of trying to time the market. You don't have to wake up and worry, is today a good day to buy? The math works in your favor over time if you just stick with it.
That's the buying side. Now, what about getting out? Redemptions. The source mentions systematic withdrawal plans, or SWPs, for retirees.
This is for people who need to create a paycheck from their investments.
Yeah.
And you can generally set it up in two ways. The first is a ratio withdrawal.
Okay, what's that?
You decide to take out, say, 10% of the portfolio's value every year.
So what's the pro and con of doing it that way?
The pro is, if the fund has a great year and grows, your 10% payout also grows. You get a raise. The con is, if the fund has a terrible year and shrinks, your payout shrinks too. The huge benefit is you'll never totally run out of money because you're always just taking a slice of whatever's left. But your income will fluctuate.
And the second way is a fixed dollar withdrawal.
Right. This is where you say, I need $2,000 a month, period. End of story. This is obviously great for budgeting. Your income is predictable.
But it sounds riskier for the portfolio.
It's much riskier. If the market drops significantly, you still take out that $2,000. But to get that cash, the fund have to sell more of your units at that new low price. You are effectively cannibalizing your account at the worst possible time.
You're selling low, which is the opposite of what you want to do.
Exactly.
And there's a tax-efficient alternative mentioned in the sources called Series T.
Yes, Series T funds are designed to pay out a high, steady monthly distribution. But they structure a lot of that payment as a return of capital.
A return of capital, that just sounds like they're giving me my own money back.
In a way they are. But here's the key. For tax purposes, a return of capital is not considered taxable income in the year you receive it.
Oh.
Instead, it reduces your adjusted cost base. So you get the cash flow now, tax-free, and you only pay the capital gains tax many years later when you eventually sell the units for good. It's very popular for retirees who want to keep their annual taxable income low to avoid clawbacks on government benefits.
Okay, this is the perfect segue to the final and I think the most mind-blowing part of our source material. We talked about risks earlier, volatility, duration, but there is a hidden risk that can absolutely devastate retirees. It's called sequence of returns risk.
This is the aha moment of the entire deep dive. It's so important. The source presents a case study of two investors, Raj and Kiran.
Let's set the scene. Both of them retire on the exact same day. Both have $100,000 in their account, and both decide they need to withdraw $20,000 a year to live on.
They have the same plan, the same amount of money, and they invest in the exact same volatile equity portfolio.
Yeah.
But here's the crucial difference. The market returns they experience are flipped. The order is reversed.
Okay, so let's take Raj first. Raj gets lucky. In the first couple of years of his retirement, the market is great. He gets strong, positive returns early on. Then, in years 4 and 5, the market crashes.
But by then, Raj is okay. Because his portfolio grew so much in the beginning, he had built up a nice buffer. Even after taking out $20,000 a year for 5 years, and even with the crash at the end, he still has money left over. He survives.
Now, let's look at Kiran.
Kiran gets the bad luck scenario. The market crashes in year 1 of her retirement. She gets a negative 33% return right out of the gate. Then, in years 3, 4, and 5, the market recovers and booms.
But it's too late for her.
It's too late. Because she was forced to withdraw that $20,000 while her portfolio was crashing, she was selling way more units at rock-bottom prices. She dug a hole she couldn't get out of. By year 5, Kiran has $0 left. She's broke.
That is absolutely terrifying. The average return over the 5 years might have been exactly the same for both of them.
It was.
But the order of the returns, the sequence, determined who went broke and who was okay.
That is the lesson. It is so profound. When you are in the accumulation phase of your life, like Bernie with his dollar cost averaging, volatility is your friend. It lets you buy low.
Yeah.
But when you enter the withdrawal phase, like Raj and Kiran, volatility becomes your mortal enemy. A market crash early in retirement is devastating because you are forced to sell assets when they are down to fund your lifestyle.
So after all of this, what does it all mean? We've covered a massive amount of ground today.
We really have. We started with the grand theory of MPT, that you can actually engineer a portfolio to be efficient. We looked at the nitty-gritty mechanics of a manager analyzing a company's health through its financial statements and ratios.
We saw how our returns are actually built from 3 different sources: income, realized gains, and appreciation.
We dissected the scary world of risk from bell curves and betas to the counterintuitive nature of bond durations. We looked at the administrative village that keeps your money safe, the custodians, the transfer agents.
And finally, we saw how the simple timing of your withdrawals can completely defy the law of averages with Raj and Kiran. It really highlights that mutual funds aren't just a set it and forget it machine. They're dynamic, complex engines.
They are. And if I had to leave our listeners with one final provocative thought from all of this, it's this. For our entire working lives, we are trained to focus on one number, the average annual return. We ask our advisor, did this fund make 8% on average? We judge everything by that average.
Right, it's the only number anyone quotes.
But the Raj and Kiran example proves that in retirement, the average is a lie. The sequence is the reality. And it suggests that true risk management isn't just about what you buy. It's about when you need to use the money. The moment you start taking money out, the definition of risk changes its shape entirely.
That is a powerful and slightly unsettling place to leave it. Thank you for guiding us through the machinery today.
It was my pleasure.
And thank you for listening. Hopefully the next time you look at your investment statement, you won't just see a number. You'll see the engine humming away underneath. Thanks for taking the deep dive.